Just a month ago, we were not factoring in forecasts of 80, 90 bucks a barrel for oil. How is that changing your outlook?
Well, I think from the start of the year, we had an anti-consensus view about inflation and about rates. That is, we believe that rates and inflation will have to go higher. And we dissected into between short-term structural issues as well as longer-term structural drivers. And one of the things that we noticed in the structural forces of deflation essentially has been on wane, and things like globalization to become localization, China being a net deflator of goods prices has come to an end. So we do see some of these structural forces of deflation waning. But at the same time, the short-term cyclical drivers of inflation, things like supply chain bottlenecks, certainly has taken us aback in terms of we didn't expect it to last that long. So overall, expect inflation to trend higher, rates will go higher. And we are entering an era or a period where it's very difficult for central banks to balance between monetary policies as well as a slowing growth dynamics.
Despite the challenges, some are saying that the bull market in equities will persist, but not you. You're underweight now. You've downgraded it. Why not? I mean, we have, the market flush with cash. We have consumers also having lots of savings, and that could well support the equity market.
Right. There's a distinction that we have to make here. Underweight equities doesn't mean not owning equities. Underweight equities do mean that granularly you have to express different forms of sector and regional bets with regards to the kind of macro environment we'll be going to, right? Higher rates, higher inflation, a normalization of policy. These tend not to do well for sectors like, tech, growth stocks with no earnings or no EBITDA. But at the same time, it tends to favor stocks like healthcare, the defensive sector, or even in cyclical value sector like financials. So we are overweight in financials. We are very overweight in healthcare as well. But on the other hand, we have pulled back our bets in the tech space, probably the most underweight we have been in a while.
Edward, I just want to dial back to what you were mentioning about inflation. We've talked, of course, about the supply chain issues. We've got also, of course, these commodity prices on a tear. But, of course, that's been feeding into factory gate prices in China. And, for years, I go bang on about this whole time, that China exported deflation or disinflation. Now it could be exporting inflation, because if we look at the correlation between factory prices in China versus, let's say, US CPI, they're closely aligned. What do you make of that?
I absolutely agree with you on that. That is the reason why when we started out looking this year, the path of inflation, we try to understand longer-term structural forces that has pushed the deflationary environment that we are accustomed with in the last 20 years. Many of these, particularly the one that you just mentioned right now, is reversing. China is no longer a cheap place to produce goods. So yeah, we need to monitor that. And truth to be told, it is coming to our current forecast where China is indeed possibly importing inflation. So,
typically, what does well in an environment like this?
Right, good question. Where we are in terms of an environment of rising rates and policy normalization, commodities tend to do well. So we have the largest commodities exposure that we have had for a while, mostly in commodities rather than precious metal. Dollar tends to do well. As a matter of fact, what we are thinking about what will look like next year is potentially a repeat of what happened in 2018, where we have a pullback of monetary stimulus, we have an economy that is normalizing in terms of the growth. And if you all remember what happened in 2018, many asset classes don't do well. In fact, on our monitor of 29 asset classes that we look at, there's only been 2 asset classes in 2018 that had positive return. One was the dollar index, and one was yen. And yen positive return only came at the last 2 months of 2018. So the way we set up for next year, we think it's going to be a repeat of 2018, a pullback of fiscal monetary stimulus, a slowing down of the economy, and I think the dollar and commodities tend to do well. And I think yen, the initial reaction will be what we're seeing right now, the further depreciation of the yen before some sort of recovery towards the year.
Edward, I want to take a look at the bond market. Investors dumping EM bonds at the fastest pace since March 2020. I mean, what do you make of that? I mean, this hunt for yield no more ahead of the fat tapering?
We have a contrarian view on that. In fact, we have to differentiate with whether the outflow of EM bonds is driven a lot by what's happening in China bond market. And it is. The China bond markets is just, the prices right now are quite dislocated, particularly in the property sector. We see a similar issuers yield is actually trending higher on the nearer term tenure than the longer term tenure. It doesn't make sense. So I think that there is concern within China property market, but it has not led to a systematic risk within China itself, nor should it lead to a systematic risk outside of or into the rest of the EM complex. So the yield, search for yield is still there. In fact, we are trying to pick up some of these EM bonds, particularly in some of the investment grade property developers right now, in fact.